Hello, good afternoon, everyone. All right, so we just opened this up. Um, People are joining in, so we'll give it a few minutes for everyone to join in, and then we get started. Hi, good afternoon, everyone. Welcome to this webinar. I'm really just trying to allow a few more minutes for you guys who've joined in to settle down, and also just to give like a grace period for more people to join in before we kick off this conversation proper. Um, all right, guys. All right, great. Yes. So while we still allow a few more minutes for people to join in, I'd like us all. So some people already started this. I can see Ame here. I can see Cynthia Chukuma. Um, a few people just saying hi. So I'll just like for some more people to say hello and just let me know or let us know why exactly you are excited for this particular session. What exactly, I know what the topic is and I know what we're trying to um, pass down, but why are you excited to listen to us this afternoon? What exactly are you trying to pick up from this? I want to see comments. Mm. All right. Um, Not seeing too many comments on there, but all right. So Philip is saying, I want to know which asset class to invest more on during this inflation period. That's a very good one, Philip. We're definitely going to answer that question on this webinar. So the whole point of this webinar really is to be able to um, share with us how we can manage our finances as a whole during periods where inflation is growing at a fast rate. So you definitely get more insights on that particular aspect on here. Kelechi says, I'm excited because this is definitely going to help me understand inflation and how to maneuver it. That's definitely correct, Kelechi. That's our goal here. Um, look forward to learning about managing my finances through this season of inflation. Great, great. I want to learn how to make more profit in this period. Lovely. I'm excited because I would like to know which assets we can invest during inflation, and I also like to where's that? And I also like to know when Rise will come to Ghana. Who's this? Oh, Kwabena, you're Ghanaian, aren't you? Wow, wow, wow. That's quite interesting. Ghana, we've actually gotten this question a couple of times. Um, I can't put like a time period definitely. At least it's not something I can say even if I knew. But rise is definitely expansion is definitely on the cards. And when expansion really begins, Ghana will definitely be one of the markets that we are going to touch. Sir, please be more audible. Oh my God. I hope you guys can hear me. Tito, can you hear me clearly?
I can hear you clearly. I can hear you clearly.
All right, all right. I'm so glad to be here. I can't wait to get more info about investing during this period. Yeah, Kwaba, you're Ghanaian. Yeah, nice to meet you. Rise will come to Ghana soon. Soon. Expansion is on the cards. All right, so I think we're past 5 minutes into the hour. I think it's safe to begin. So good afternoon, everybody. My name is Chukwubikem Oguzie. I am the community manager here at Rise Vest. Um, Welcome to today's investment club meeting. So we hold these meetings during the last Saturdays of every month. And the point of this meeting is to have another medium to do what we do in the Rise Investment Club. If you're someone who's been a part of the Rise Investment Club, you know that we're passionate about financial literacy. We're passionate about having money talks. We're passionate about having conversations about our finances with the aim of growing, with the aim of learning and growing our finances together. So that's what this investment club is all about. These meetings are all about. It basically just gives us a platform to have much more deeper conversations, extended conversations on a specific topic. So I keep seeing my volume is low here. um I don't know if that's on my end or it's just you. Tito, is my voice is my audio too low?
Yeah, probably might need to speak a little bit louder so that I think that might be the problem because I can hear you clearly, but I think okay.
Okay,
A number of people is or people persons again are saying that it's low, but I think you just need to your voice is low from my end too. So I think you just need
okay.
to yeah adjust your your mouthpiece and speak a little bit louder.
Okay, generally, I don't think I'm a loud person generally, but I'll try to be louder. From what I see, it just seems like um, I'll try to be louder anyways. I just saw someone say it's okay. But yeah, I'll try to be as loud as possible. Right. So today, the conversation we're having today basically is the topic for today is how to manage your finances during periods of high inflation. Um, all right, so Cynthia says better. The speaker is loud and clear enough. Great. So the reason why we're having this conversation is because of the simple fact that we can't run away from the topic of inflation um, in this particular time. Um, just coming from the disruption to the global economy that we had during the pandemic, just to put that into context, the pandemic shut down a lot of industries, and that affected the supply chain, right? So what that is that because a lot of processes had to stop when we're during the lockdown. um when those processes were back up, there was now a lot of demand that the supply end had to catch up to, right? You think about that. You also think about the fact that central banks all over the world had to, at some point, and this wasn't all central banks, but if you, at least if you think about the US, for example, the US did it. So they had to, at some point, find some sort of support for their economy. And this came in like different ways. But what that ended up doing was making sure that there was more money in circulation. The whole point of that was to um, stimulate demand, to make sure that economic activity was still going on to a certain level, even while the lockdowns and COVID-19 was just going crazy out there. Now, the aftermath of all of that, coming into even towards the end of last year, but definitely coming into this year, was high inflation rates all over the world. Um, if you read finance news, it's been a buzzword for the longest period. So that's the reason why we wanted to have this conversation, since it's um, a phenomenon that um, we are dealing with as a global as global people. Is definitely very important to have this conversation to understand how we can navigate our finances, how we can maneuver our finances during periods like this. And that's why we're having this conversation today. So today I'm joined with Tito. Tito is here with me. So Tito is a member of the investment research team at Rise. There his picture is, handsome looking gentleman. Yeah, thank you for joining us, Tito.
Yeah, hi
So
guys.
Tito, yeah, just say hi to the group. Let us know what you do at Rise, and yeah, we kick off from there.
So hi guys, I'm excited to be here at the investment club and talking to you guys about the topic that we are going to be discussing today. So I think it's a very important one, and everyone should learn how inflation is affecting their money and how it's affecting their investments generally. So I'm glad to be here, glad to have great conversations. Let's get it. So basically, I am doing investment research. Um, yeah, advice at least help coordinate some of the processes around that. So ensuring that we are picking the right investments and the right stocks for you guys. So basically, that's basically what I do. So I think I'll hand over back to Chibi where so that we can at least get the show on the road.
Thank you so much, Tito. So yeah, guys, that's Tito. If you're new to this club meeting, if this is your first one, I'll just give you a brief of how the structure is going to go. So basically, Tito and I are going to have a conversation around this topic. This conversation is going to answer a lot of basic questions around this topic, and is supposed to um, give you insights that you could basically latch onto, that you can basically utilize after at the end of this conversation, right? And so we'll do this for about 30 minutes between Tito and myself, and then we'll open it up to questions from you guys here. So there's a Q&A session there. There's a Q&A section. You see it at the bottom of your Zoom screen there. You can just type, you can just click on that, ask questions, and then when Tito and myself are done, we would address these questions. Right. So let's jump right into it. First thing we want to speak about is inflation itself. So if you do not know what inflation is, inflation basically is the gradual increase in prices, general price level of goods and services in an economy. So if you think about what 100 naira could buy last year, 100 naira could probably buy you like a bottle of Coke last year. And this year, they tell you that that same bottle of Coke you're buying for 100 naira is now worth 150 naira. Um, that essentially is inflation, right? Um, Now, the way the economy works, there is um there's a certain amount of money in circulation, right? So money in circulation is supposed to represent the value of goods and services within the economy. So there's a million naira in circulation in Nigeria. What that's supposed to mean is that there's a million naira worth of goods and services in Nigeria, circulating in Nigeria, that justifies that money that is rolling around. Um, so if, for instance, this money supply increases, and then the value of those goods and services in the economy does not increase, then what will happen is that the prices of those goods and services would naturally just go up. That's to account for the extra money that's now in circulation. That's like a very simple way to explain one of the causes of inflation, especially the particular inflation that we are, dealing with in this country, and like on a global scale, right? Now, that's what inflation is. Now, the next question you want to ask is, how does inflation affect you? We hear inflation all the time. We've always heard about inflation right from when we're studying economics in secondary school. So how does that affect you and I, as people? Well, the simple and the single point that I want to dwell on is purchasing power. So again, let's go back to that 100 naira that we're speaking about. 100 naira will always be 100 naira. 100 naira was 100 naira in 1980. 100 naira is 100 naira in 2022. It's still the same number. It's still the same denomination, right? Um, but the purchasing power, that's what the value that 100 naira can fetch you, is what will change over time. So, like I said, if you had 100 naira last year, and that 100 naira was able to buy a bottle of Coke for you, now that 100 naira can no longer purchase a bottle of Coke for you, because now they tell you, oh, for such and such reasons, maybe transport, maybe the cost of the raw materials that they use to make this bottle of Coke is becoming more expensive. So now they have to pass that price down to you and I, the consumers. And so for that reason, you go to the store and they tell you, oh, that bottle of Coke is now 150 naira. Now, what that means for myself, who has 100 naira in my pocket, means that the purchasing power of my 100 naira has reduced. I still have 100 naira, but the value that I can command for 100 naira has reduced. I can't buy a bottle of Coke anymore. So that's, in simple terms, is how it affects you and I. It erodes our purchasing power. So if you can imagine, if these prices, the general price level of the goods and services that we buy in our economy, are growing just as quick, um, that means the standard of living that we are currently um, used to right now might not be sustainable for us in the future, except, of course, we increase our income. So I won't be able to buy that bottle of Coke except I have 150 naira. So now I need 150 naira to buy a bottle of Coke. So that, in simple terms, is how is what inflation is, and how inflation affects us on a day to day. And while we look at inflation, just before I jump to the next segment, while we talk about inflation, we look at numbers that the NBS, or the central banks post. It's also important to understand that it doesn't all affect us the same way. So if a bottle of Coke increased to 150 naira, it only affects you if you're actually purchasing a bottle of Coke. If you never have the need to purchase a bottle of Coke, then that inflation doesn't actually affect you. So there's something called personal inflation rates as well. Inflation only affects you when you're actually going out there to make purchases, right? Um, so now, Tito, I want to bring you into the conversation now. Um, we
Okay.
know that now inflation is not totally a bad thing, right?
Yeah.
There's a
Yeah.
certain level that central banks try to keep inflation at. So I know the US,
Hmm.
the Federal Reserve tries to keep it at 2%. So that means if
Yeah.
inflation is increasing by 2%, that's actually decent. The problem now, you know, comes in when inflation is growing at a higher rate than the central bank wants it to grow, right?
Yeah.
So we know central banks manage inflation. But Tito, please, could you tell us um, how, just give us a little bit of insight. You don't need to go too deep into this, but give us a little bit of insight into how these central banks actually manage inflation. What tools do they utilize to actually manage inflation?
Okay. Okay. Thank you very much, Chibi. Where do we are once again? So I'll just get straight down to it. So basically they're like inflation can be looked at like from like two different ways. So we can look at it from like a cost direction, a cost perspective, where probably the cost of producing goods and services have increased. So definitely the producers also have to um like translate that increase in cost of in raw materials to the final cost of the product. So and then it can also be from a demand perspective, probably a perspective where demand is outshining supply. So or where you have like a lot of people demanding for a particular good and then there's not a lot of supply of that good. So that automatically drives the price up. Like something like what happened with the fuel scarcity that we had recently here in Nigeria. So that's a typical example of demand pull like inflation. So to now come down to what Chibi was asking me about how governments and how governments and how agencies generally manage inflation. So, like you said, for that, the central bank or the monetary authorities in a particular country or in a particular, for example, in Nigeria, the CBN is the one in charge of ensuring that money keeps flowing in the system and then that money supply is not leading to inflation. So there are a number of ways in which the central bank tries to curb inflation if inflation is going above the target in which they've set it. So number one would be by increasing interest rates. That's lending interest rates. So when you increase interest rates, there's what it's called the benchmark rates. Like in Nigeria, I think they call it we call it MPR, like MPR rates, like that number rate. So that's the rate at which the central bank, Nigerian central bank, lends to banks, commercial banks. So the commercial banks are generally like the money lenders to people in the economy. But before I even move down to that, let me quickly talk about why it is so important to curb inflation. So inflation left unchecked, number one, is going to erode a lot of purchasing power, like Chubi has said earlier. So your purchasing power is, you can't purchase the same value or the same amount or quantity of goods you purchased, like let's say last year. You can't purchase that same value now. You can't purchase that same amount of units or quantity this year. Basically, just like what Chubi has explained, like a Coke was 100 naira last year. This year, if you have 100 naira will not buy you a Coke this year. So it is important to curb inflation. Number one, to curb that erosion in value, so that people don't tend towards a poverty, so that poverty doesn't like impoverish the economy. So that's one major reason why inflation needs to be curbed. Then inflation also needs to be curbed also to ensure that generally the economy can be supported, growth can be supported in the economy. So when prices are way too high, people's disposable income, so price has to, if an increase in price is going, it means like an income, people's disposable income is not growing. So when I say disposable income, that means people are not getting raises at their workplaces because it is becoming more expensive to goods are becoming more expensive, and people's what's it called? People's potential income or people's salaries are not being increased also. So if there's no great proportion as a commensurate proportion change in both sides, this will obviously lead to what we said earlier, like poverty. So because people are not obviously having enough to purchase whatever it is that that it is that they want to buy. So for these two reasons, major reasons, I think it is important that government keeps inflation in check so that people can generally better their lives, improve their standard of living without necessarily worrying about prices of things going up. So because when prices of things go up, companies will have to pay more, incur more cost on personnel. So it's like a merry-go-round or a link of a chain of events that will just end in absolute poverty if that is not checked. So back to my explanation of how the CPN use interest rate to curtail inflation. So when CPN increases the rate at which it lends to commercial banks, that automatically increases the rate at which commercial banks will want to lend to personal consumers of loans or businesses in general. So when that happens, it means businesses find it more difficult or more expensive, that's the word, to raise funding for expansion, for whatever various needs that they need to use the money for. So, and when it becomes more expensive for them to raise money, that like in turn it slows down like their expansion rate. It creates like a concern for future growth about that particular company or about the company in general. So when that happens, inflation, the cost of what's it called? The cost of that particular good is like reducing the amount of money in supply. So the aim of increasing interest rates is just basically reducing the amount of money in supply. So what is happening with inflation is that so much money is out there, pursuing very few very few goods. So what is happening is that with CPN increasing rates, they want to reduce that money supply. They want to keep that money supply in check and allow the units or whatever people are chasing with that money to come up in terms of supply, so that when that comes up, then there can be a reduction in price. So price crashes that way. So let me just give like a simple analogy of that. So like what is happening currently around the world. So because of the pandemic and because of the pandemic, a lot of governments and a lot of economies have tried to stimulate growth by paying monies directly into people's personal accounts. So like in the US, I think which is where Rise invests most of all of our assets, or that's where we invest all the funds that we get from users. So like for US, for example, like there was like over a almost a $2 trillion stimulus package that was sent out. That money was paid to businesses, was paid to personal accounts. So if you account for that, that's a lot of money that are in people's hands, and people need to spend, and people need to let this monies go. So people need to find a way of letting these monies out. So another side to that is that because of the pandemic did not only like cause government to put money into people's hands, but also created like a supply gap. So because of the lockdowns that happened all over the world, like goods and services, companies were not manufacturing goods and services because nobody was going out to really get all these things. Everybody was inside their house, so nobody was really buying all these things. So companies generally cut down on their production for the sake of that. Not many people are buying one, and also to curb the virus, so that obviously when people don't move around, obviously the virus doesn't get to spread. So obviously everybody wants to stay indoor and ensure that the virus doesn't continue spreading. So that led to a lot of supply chain issues. So because of that, let me just round up this topic so that we can move on to the next question. So because of that, there's a lot of inflation came up. So a lot of monies were chasing very few things that were available. So obviously prices of goods and services went up. So what government just essentially tries to do with hiking interest rates is that they try to reduce that money supply. They try to reduce that money supply and then ensure that when the supply of money is reduced in the economy, obviously fewer money will not start chasing fewer money start chasing the available goods and services, and then prices can crash. So that's another way. So another way is government reducing their spending. Let me just quickly mention that this briefly. Is also by government reducing how much they spend in the economy. So if government is doing a lot of infrastructural projects, a lot of this thing, they want to like take a little step backwards and try to reduce how much money they are putting out in the economy. So there are like different ways in which like government tends to manage inflation, but those are the key major ways, either by reducing government spending or by increasing rates or increasing taxes, like even not interest rate, like increasing taxes and stuff, so that a lot less money can be available in the economy, and then a lot more goods can, if a fewer monies can chase like the present goods that are happening. So that's basically
Yeah.
what
Thank
that
you so
is.
much for that, Tito. So I'm just even looking at the time here. We need to run through this quickly. We usually have
Yeah,
fun like when we're having this type of conversations, but you'd be surprised at how time flies. Um, so just to sum up what Tito just answered, um, with the use, so governments use interest rates, and then other tools like government spend. So basically what they are trying to do is, if prices are going up, if inflation is running hot, what the government wants to do is that it wants to cool it down by reducing the money supply out there. And one of the reasons why if high inflation is very very synonymous with like interest rates, because there was this whole conversation last year, will the Fed increase interest rates? People were expecting that, because that when inflation starts running hot, what they do, like Tito just explained to us, is they increase the interest rates, which makes borrowing money basically more expensive. So when that happens, that kind of just reduces the money supply. Same thing, like like you mentioned, Tito, just also reducing um
yeah,
government expenditure as well. So now I want you to speak specifically about um the particular season, or this particular, because different things cause inflation, right? So just touch on
mhm.
this particular uh period that we're in. What are the, just give us the main ones, and you don't have to go extensively into them, but
Okay,
what are the main drivers of the current global inflation that we are facing? I know you mentioned them in your last when you answered
yeah,
the
I
last
mentioned it
question,
before.
but just briefly touch on them again, please.
All right. So I'll just quickly move so that we can talk about other things. So number one thing that is pushing inflation currently, before I come to the a lot more obvious one that is like happened recently, and that is pushing prices upwards. So I'll start from, like I mentioned earlier. I already mentioned the fact that there was a pandemic in 2020, which led to governments putting out a lot of funds, putting out a lot of monies in households and in a lot of people's accounts. So globally, all over the world, I think at least in the US, in like in developed economies, that's what happened. So I'll still scale down to what is happening in Nigeria, and because I don't think Nigeria is not definitely not because government put money in the hands of people. So um, I'll still scale down to explain basically what is causing inflation here in Nigeria. But let me start on a global level and then scale down to what's happening in Nigeria. Um, well, like in developed economies generally. So what happened was that government put a lot of money in people's hands by paying directly into their accounts. So because of that, um, people have like a lot more disposable money to spend. So that's one side of it. The other side of it is the fact that because of this lockdown, or because of the pandemic, also companies couldn't produce goods and services, as because obviously not many people were purchasing all these goods and services because everybody was in their house. Then also to cut, like I said earlier, to curb the spread of the virus, everybody had to stay indoors. You get so that led to lower like production, so lower supply of goods and services. So basically, people had so much money to spend, and then they didn't have anything to spend it on. So prices of goods and services generally just went up because there was not enough supply to match the demand that was at stake. So that's an example of a typical example of a demand pull inflation. So because demand was up, was very high. People had money, people wanted to spend money. So and then basically they couldn't get this money spent because there was nothing to buy. Like everywhere was on lockdown, nothing was being produced. So obviously, and that pushed prices of the available goods up. So that's basically one thing that is causing inflation. So the next thing that is even more obvious and is even more current is the current war in Ukraine. So that is causing like serious havoc when it comes to inflation. So because inflation was already high in a lot of economies, like developed economies all over, like in US, across Europe. So and so so let me give a brief context to why things are like it is now even worse off for developed economies now. So Russia supplies like about 60% of the gas that Europe used to power their to generate energy. So that's one. So secondly, Russia accounts for 10% of the global oil, like oil that we use all over the world. Like Russia accounts for 10% of that. So Russia is also like the largest producer of some food items like wheat. Then there's some metals also that they are also like I think powder and some other like key food items and metallic items that especially this company that used to make chips, they used to make computer chips, and so Russia is like Russia and Ukraine, they're like the biggest exporters of some of those things. So because of the war going on, obviously a lot of production is not going to be happening in Ukraine. So we can bank on the fact that everybody's running for their lives in Ukraine and nobody's even bothered about producing anything right now. So that's a loss on their own supply, on their supply of all those important like commodities that the world needs. That's a shortfall there. One. So when you look at on the Russia aspect of things, Russia has been battled because of their invasion of Ukraine. A lot of sanctions are coming Russia's way. So that means a lot of people are boycotting, or a lot of people are saying, oh, we're not buying this particular good from Russia. So if Europe is trying to say that, oh, right now we are not going to be buying gas from Russia, that means that 60%, they have to look for where they're going to be getting that 60% that they're going to be losing from Russia, and that's a whole lot, because it means you have to find other sources like of raising energy if you're not going to be using Russian gas. So basically, because of that disruption in supply chain, because of the war and because of the sanctions that are going on, the cost of energy has gone up. So when the cost of energy goes up, which means the cost of powering plants, the cost of powering households, like your basic cost of electricity are basically gone up. So if a company is spending more generating its own power, it means that it's going to scale that effect down to its users by increasing price of whatever it is that they're selling. So automatically that increase in what's it called? That increase in energy prices. Like for example, now oil prices I think are almost $120 right now. I think they are doing like 114, 16 thereabout. I think last I checked was like 114. So we can be sure that shortfall for all these energy products and for supply of energy is going to be causing a whole lot of inflation. So that's like the context. So those are the two things that are driving like global inflation currently, like the war in Ukraine, and then obviously our inflation that already spiraled from the pandemic. So moving down to Nigeria now, which is more of a case of a cost pull kind of inflation. So what is happening here is Nigeria is that a lot of things so Nigeria is an import-based economy. So because we import a lot of stuff, so and when you're importing, and like I just explained now, things are not expensive in Europe. It's more expensive to do some of these things in Europe, in the US, where we're importing a lot of these things from because of increased energy costs. So if all of this is happening, and we're importing all of these things, so obviously we're going to be importing at a higher price. And that's not even accounting for the fact that there's an exchange rate problem in Nigeria. That's also adding to the inflation problem. So because of that, basically, we're importing expensive goods, and we also obviously someone that is importing want to make profit and the likes like that. So obviously that causes like inflation also. You get, so that adds like to the price. So more of what we're experiencing here in Nigeria is more of like a cost kind of thing, because it's not like as if the goods are not available for us to buy, or it's not like as if people don't have money to buy these goods, but it's just that goods are becoming more expensive generally because the cost of getting those goods in on board here is also becoming a lot more expensive. So that's one thing that is definitely triggering like inflation
Inflation.
globally, and that's
Yeah.
also triggering inflation here in Nigeria. So as not to take
Yeah.
more time again, let me just cap
Thank you.
it there.
Thank you. Thank you. Thank you. So guys, the reason why we the reason why we structure this conversation like this is because we want we want to give a lot of context. So it's not, we don't want it to be a situation where it's like, oh, this is what you should do when there's periods of high inflation. No, we want you to understand a bit of context, like why is this inflation even there, like what are the causes. Like, it's, if you think about it from an investment perspective or from an investor perspective, um, even just knowing how these balls move around helps you think better, not just in investing, but in your finances in general. That's the reason why we try to give this much context. So let's go to the meat of this conversation, Tito. Then after this, we just open up questions, right?
Okay,
All
okay.
right, great. So we know what inflation is all about. We know the drivers of the current global inflation now. I want you to tell us two things, right? How do we invest during periods of high inflation? So talk about the briefly talk about the asset classes that um, do well during these sorts of periods. And then secondly, from a Rise perspective, since you're like a member of the investment team at Rise, how is Rise actually setting us up as customers to basically benefit from this period, or to be able to scale through this period? So please shoot this as quick as you can so that we can take
Yeah,
questions. Yeah,
I'll just
very well.
I'll just run through it. So straight up, during times of inflation like this, what should drive your thinking, or how you should think about this is, you should think about it from a time horizons perspective. So when I say time horizon, I mean your timing your timing, like your time duration you want to be invested in whatever asset class that you're investing in. So because that's majorly what would determine what kind of assets that you should be putting your money into. Because there are assets that perform well in the short term during inflation periods that don't perform well in the long term during inflation periods. So, and there are asset classes that perform well both in like short-term periods and in both in long-term periods during inflation period. And there are some that don't even perform at all during short-term, like in the short term during inflationary periods, and then in the long term, they're probably the assets that you want to stick with. So number one is, let's talk about stocks, equity. So equity in the short term in inflation doesn't perform well. Like stocks are always the first casualty when it comes to inflation, because once government increases interest rate, it affects cost of borrowing for companies. So investors are basically worried about the future growth of companies. So because they are raising money at a higher cost, they can't have more money to expand as they should. So obviously that creates like a doubt around how the company perform in the coming years. So when that happens, investors pull back, and then their confidence in the stock market at that time takes a beating. So, and when that happens, yeah, you don't want to be like, so stocks might not be good in the short term for inflation. So, but what is good in terms of equities for short term in inflation is equities that are linked to commodities, to commodities. So when I say commodities, I mean food items, like wheat or metal or metallic materials, or materials that mostly people cannot do without. So probably like now, the world will still continue needing like metals to produce chips. So you probably want to be invested in a company that is producing that metal that is needed to produce chips, because a lot of the world is going very mobile and very digital. So chips are recorded like on a crazy scale. So that can be, so that's another like material, like equity based materials. Material based equities are another thing that is good in the short term when it comes to like inflation. If you don't want to be invested in a general equity market, so because that's not where you want to be in the short term, if you're looking for short term returns in the period of inflation. So another thing that you should be considering is energy related stocks. So energy related stocks generally like your ExxonMobil, your Chevron and the likes. So are the kind of stocks you also want to be backing, because at the time of inflation, like people will still require energy. Like people will still need to power their cars and power their factories and stuff. So energy stocks generally don't take a beating during this period, because they will obviously people demand, and then their future growth is also assured. So those are, like, when it comes to equities, those are the things that in the short term, those are the things that you want to be considering. So, but stocks in the long term usually perform well in what's it called, in a period of inflation. So like stocks are even like the best, like they'll tell you that stocks are the best form of hedging against inflation when you are thinking long term, when you're thinking, okay, I want to be in the market for a long term. So because at the short term that stocks are taking a beating, they are becoming cheaper. So it means you can buy more at cheaper rates and then hold for when it goes, like prices increase when inflation starts cooling down. So at the time inflation starts cooling down, prices of your stock start coming back, because confidence in the stock market comes back, and then people believe that, oh, companies can now support future growth. So obviously at that point in time, you want to be like in the stock market. So when you're in stock market early, when market has crashed, and then you can all ride it all through and not take your money out. The key there is not taking your money out. So when you don't take your money out and you ride through the inflationary period, at that long term, you're cashing out on the returns that it's definitely going to be above inflation at that time. So I'll move on to the next asset class, which is real estate or properties. So generally in the short term, like in the short term, in the medium term, in the long term, like properties and like housing or real estate in general is a good edge against inflation, because even though it might take like a rough like a little bit of shake because of mortgage rates. So because when government tries to increase interest rates in terms of curbing inflation, that also affects mortgage rates. So when that affects mortgage rates, that also obviously increases the cost of being able to buying houses. So at that point in time, but that's good for someone that is holding a house, because if the value of his house is going to go up, so his value of the house of his house goes up, and then you discover that, okay, at that point in time, holding like a real estate property might probably be the best thing you want to be doing at that time, because like inflation doesn't necessarily, like your value of your house will just appreciate over time without cost of probably whatever it is that is happening, like commodities affecting whatever it's happening in your like your energy or cost of your goods and services doesn't affect what happens in your real estate property, in your real estate market. So probably what affects that is the rate of is the rate at which people can borrow to construct houses. So which is also a good thing for people that already own houses, because at that time the value of their real estate will have gone up at that particular time. So real estate is just basically a good time to be in them, to like a good asset class to hold also. And basically because people are also going to need shelter, people are always going to need to have a roof over their head. So it just makes sense for you to be like holding real estate, whether short term or long term, because people are always going to need houses and properties to live in, or for businesses, or for whatever it is that they need them for. So that's like a key commodity, just like the way food items and the way energy is a key commodity, which supports like the stocks that you're buying if you are thinking in that direction. So I'll move down to cash. So cash. So when I say cash, I mean like government-backed, what's it called? Government-backed bonds or government-backed yields. So some of these government-backed. So generally during inflation periods, government rate of, because obviously government at that point in time increases interest rates, like that's benchmark interest rate, lending rate, they increase that. So but because at that time a lot of people like put more content to put more confidence, try to shy away from the volatility in the stock markets. They try to move down towards something that is still in the financial markets but is less volatile and it gives guaranteed return. So because of that shift from the stock market to the fixed income market, which is like our government-backed bonds or our government-backed bonds or treasury bills, that pushes the rate of treasury bills upwards. Like currently in the US now, the treasury rate, 10-year treasury rate in the US is at records, because that's like 2.47%. I think that's like the highest that's been in like 3 years, I think. yeah, for in the US, and that's like fantastic because a lot of people will be able to run away from the volatility in the stock market and protect themselves by using like that those guaranteed sums of amount that comes from your investing in government backed what's it called um in government backed securities, which are usually sometimes, like in the case of Nigeria, there was a time, like I think in 2016 thereabout, when inflation was so high, and then we inflation was high, I think it was around 12 point something percent at the time. And then a lot of mutual funds, a lot of treasury bills that time was doing like 16, 17% um above what's it called? Above inflation rates. So it was really a good time to be in the fixed income space that time in Nigeria. So yeah, generally cash related cash equivalents like your government bonds are usually over the period of time of inflation are usually a good asset class to hold also, but they won't most likely be the best. They are not the best. I need to point that out, but they edge you away from the edge. They reduce, like they help edge inflation to a certain extent, but they are not obviously not the perfect edge to inflation. So the other thing that you can put, the other thing that I think that I need to mention again is over so FX can be a way of or foreign denominated assets also can be a way of edging against inflation. Like in the case of Nigeria now, where the naira is taking a beating and then the inflation is high, so you can like put your money in dollar denominated assets. So that helps you edge against inflation in Nigeria, even though inflation is also going up like in the US. But the inflation rate in the US is not as high as the inflation rate in Nigeria. So you can still take advantage of that spread. So like putting your money in dollar denominated assets are also like a very favorable way of edging against inflation. Sorry. So then generally you also want to be invested in, like I said, not only stock related and like not only material or energy related stocks, but so you can even be invested in like the energy like system itself. Probably start a business in the energy space or start a business selling goods and services. That's like another way like you can edge your money against inflation. So plus just basically when you keep your money like or participating in the commodities exchange like platform. So like I think in Nigeria we have FX, so that helps people like be able to buy and sell like futures or futures contracts on on commodities. That's food items generally. So you can also be in that, like participate in that space, and you can be rest assured that you'll be edged against inflation, but in mostly in the short term, anyways. For energy, like for energy commodities, like and if you're investing like in commodities and energy space, like you only be like safeguarded from inflation in the short term, but like it's a great edge against inflation. Like that's where you want to be, like in the short term. But towards the long term, it's not like it's not a good edge. It's not still a good edge, but it's just that it doesn't edge you as much as it does in the short term. So you want to probably like stay in the short term. You want to probably stay with energy and commodity stuff in the short term, and then in the long term you want to move towards equities, like you want to move towards your stocks. So that way you can ride through inflation. So the best formula that I would say to ride through inflation is stay with energy, stay with commodities in the short term, and then in the long term move towards equities, and then you will just be fine. You will just be fine. So I think that's basically the major asset classes
Yeah.
that help you edge against inflation.
Yeah. I like the way you ended it. I like the way you ended it. In the short term, stick to commodity related stuff, right? So stick to the stuff that is directly being inflated, um, directly being affected by the current inflation. And then
Yeah,
in the long term,
exactly.
stick to equities, because equities historically have always been the best hedge against inflation. They've always outperformed inflation over the long term. Thank you so much for that, Tito. So let's quickly go on and take some questions. So guys, please, it'll be much more easier if you send your questions to the Q&A section, instead of also just putting them in the chat here. So I'll run through some of them in the Q&A, and we'll just pick up the ones that are already pasted here in the chats. So the first one here, Chike Ugochukwu says, I have a question. Saving for school fees, please, is there any percentage to get during the period of saving in Rise? So this person is talking about the school fees plan on Rise. Tito, do you want to take this, or do you want me to
I
take
think
it?
you should just go ahead and just
All
start
right,
that.
so you're asking if there's a specific percentage. So here's how it works, right? When you invest in a goal-based plan on Rise, so you're investing towards your school fees, you answer all those questions, and then it gives you a sort of investment plan. So it tells you how much you should be contributing on a monthly basis to make sure that you reach your targets when you want to reach your targets. So depending on how long your horizon is, what it actually does is that it spreads your money across a mixture of the three asset classes, right? So if, for instance, your goal is less than a year, most of your funds will be split between real estate and fixed income. If it's longer than a year, it will be split between fixed income, real estate, and stocks. So while there's no fixed percentage, what it tries to do is that it tries to expose your money to the asset classes that will help you reach your goal at that period, and then even add some returns on it. So that's exactly how it works. So if you have like a 5 year, if you want to study, if you want to take like study for a degree in 5 years, and you have a plan on Rise for 5 years, it will split your money across those three asset classes so that you get exposure to as much capital appreciation as possible. But then as you get closer to your goal, let's say you're less than a year towards your goal, all the capital appreciation that the plan would have gotten for you, it now tries to protect that by reducing your exposure to things like stocks. So that's exactly how it works. If you need that, that's a product question. So if you need much more explanation on that, you can hit us up, mail us hello@risevest.com, or just send a message on Telegram, and we'll try, someone will try to explain that to you much more clearly. So I hope that helps you out, Chike Ogochukwu. An anonymous attendee says, for example, if I have 500K today, would you advise me to put it in a Naira investment with 15% interest per annum, or convert it to USD and put it in an investment with 7.5 interest per annum to hedge against the current inflation rates? Also explain the why behind this advice. Right. Great question. So they're basically asking
Very,
if it's
very good
best to,
question.
like, yeah, hedge against inflation in Naira or USD. So the Tito, I'll try to answer this and you can like
Okay,
add your part. Yeah.
okay, that's fine. That's fine.
So the point of trying to hedge against inflation is you're trying to make returns that are beating inflation. So if inflation is at 10%, you want to make sure that you're earning returns that are above 10% so that your money is growing faster than the inflation rates. Um, what Tito, what's the current Naira inflation rate?
Foreign inflation is 15.73.
15. Yeah,
Yeah,
I knew it was almost
7%.
16%
Yeah.
ish. Yeah, yeah. Okay, so let's say current Naira inflation rate is 15%. So anywhere that you're not putting your money in the long term, that is, giving you returns of more than 15% in Naira, you're not beating inflation. You're losing your purchasing power on that. So the answer to your question from my end really would be, and let me just look at that question one more time. Yeah, so the answer to your question would be, it depends. If you're trying to hedge in the long term, I would say you should lean towards the USD. Simply because I know inflation rates right now in USD is what, 6%, C to 6%, if I'm not wrong.
No, inflation in the US. Oh,
Yeah.
oh, inflation in the US is kind of high right now. It's like about 7.9%.
Seven, all right. So let's say 8%, right? Um the lowest plan. the lowest returning plan on Rise gives you 10% fixed income per annum.
Yeah,
So even just with that, you're already beating inflation and still adding to the value of your money. So if it's for the long term, switch over to USD simply because even 8% that Tito mentioned, I don't think it will stay there for too long. Um,
yeah.
I don't
Rates
think it
are
will stay there. Yeah.
rates
They
are
only
coming
have
up, so they're trying to
exactly, exactly.
bring
They are
down
trying to
inflation
curb it down,
basically.
right? So in the long term, stick to your USD investments, just because it's easier to kind of like hedge against inflation in dollar than it is in naira. And if it's for the short term, I don't think it really affects you in the short term. Like the inflation is really much more of a long term problem. So Tito, do you have anything to add to that answer, real quick?
Yeah, yeah. I'll just quickly add this. So if you look at the inflation rate like in the US, like we said, 7.9, in Nigeria, 15 point. So your money is being eroded, like 50% of your money is being eroded. Let's take an example, like 15% of your money is being eroded if you have it in naira, and 7.9% like is being eroded if you have it in dollars. So like it's better for you to I if I were you, I'll just, or if it were me, I'll just go for what erodes my money less, and just go for like, yeah. So I'll try to be sticking my money in the US. But besides that, that's one. Like Chibi rightly pointed out, like you can have that money invested with us, right? And then you definitely end like the lowest, like we said, uh the lowest what's it called, rate or return you can get on your money with Rise is 10%, even though we have like a wallet interest right now. So even if you're not invested in like in any plan or whatsoever, you can still, money in your wallet can still earn you 8%, which is just basically keeping you at par with inflation and saying, okay, you can stay here and still have like decent returns without like, if like having like a place whereby your money is just there and then inflation has not even eroded it. So basically, I'll just say put your money in dollars. Like I mentioned earlier, like put your money in foreign currency is a way of hedging against inflation. Like it, because that way you're, even when you're doing like the exchange rate conversion, like you obviously even gain more money apart from like the whatever it is that the returns that you've gotten from a dollar denominated investment. So basically, just go for the dollar, bro.
Yep. So thank you. That's it. Ayodeji is asking. So Ayodeji says he just joined RiseVest in December 2021. My experience so far has been a mixed feeling. What is the guarantee or insurance cover in place for my investments? Ayodeji, December 20. So you've been here like a couple of months. I hope you have a better experience going far. I'd like to know a little bit more about why your feelings are mixed, but not on this call. You're asking for the guarantee or insurance cover in place for your investments. So Rise has a relationship with ARM. ARM are basically Rise's trustees, which essentially means ARM oversees some Rise processes, some investment processes on behalf of you as the user. Also, a lot of all these assets that you're investing in Rise are, so take for instance the real estate that Tito mentioned, these properties are insured on purchase. Stocks have SIPC coverage of up to $500,000. Um, and fixed income bonds are basically some of the safest financial assets on the markets. So that's it as far as um, you know
Like
insurance
some sort of
cover
insurance.
goes. Yeah,
Yeah.
there's no, I don't like to use the word guarantee in investments. There's really no guarantee in life, period. But that's what it is. As far as safety goes, you can get some more information about this on the website. If you just read through websites, it addresses some of these questions that you're asking here. Anonymous attendee said, who owns Rise? um there are different people invested in Rise, but the CEO is AK. Um, yeah, that's about the answer to that. So Tito Samson is asking, are pharmaceutical stocks? Oh yeah, and we've gone past the 1 hour mark, by the way. I just want us to run through these questions already here, and then we can go enjoy the rest of our Saturday. This recording will still be shared on the investment club, and I'll share a link to that, so you can always join that we further these conversations there. Tito, are pharmaceutical stocks part of commodity class of stocks that can be held during inflationary periods? Yes or no?
So yes, definitely. Because health is a very critical as a very critical part of human life. Like, so
Mm,
if you need to be healthy at all times. So definitely, whether there's inflation or whether the even whether war is going on, whatever it is that is happening, people need to stay healthy.
mm,
So
yeah,
definitely, drugs that make you healthy are definitely like
yeah,
what you should be looking to invest in if you're doing
yeah, yeah,
inflation, because there will always be
yeah,
demand for that. And then you can, yeah. So
yeah.
from there.
So basically, just to add to that, they are what you call cyclical stocks, and they're what you call like defensive stocks. So what Tito is really talking about is defensive stocks. They are stocks of companies that produce things that we use every day that are essential to our life, right? So when Tito mentioned energy, when you just mentioned now pharmaceuticals, you think about it, even if there's a recession, even if the economy is not booming like that, we'll always consume electricity, we'll always probably need drugs, we'll probably always need food, we always need a place to live. So there are certain stocks that of companies that produce things that like are always essential to us. These things will always, hold their value even in times like this. And then you look at cyclical stocks. So cyclical stocks are basically what you call like luxuries. So if you think of a luxury airline, no, let's say you think of a luxury whatever it is, like a luxury bag, or a fashion company, or um someone who does tours, a company that does tours and stuff like that. These things only boom when people are happy, when there's money in people's pockets, when people have disposable income. If you don't have so much money in your pockets, you're not going to be thinking of a luxury bag, but you still think about food. So that's it for that. Somebody says, isn't it too late to go into commodities and energy stocks since the inflation has already begun? Also, how does one know when inflation has gotten to its peak so you can sell off these stocks?
Okay, I'll just go right there. So to answer that question, I'll say that so there's no, as much as you do, it's difficult to time the market uh, when it comes to stocks. As much as it's difficult to time the market, and now that inflation is already like in place, and then we're already riding through the process right now. So the thing is that there are still a lot of things that are suggesting that inflation will keep going up, like the issues in Russia and between Russia and Ukraine. So because of basically that, so a lot of people are still anticipating that inflation will still continue to go up, because if a solution is not found to the energy, like supply, the disruption in the energy sector, in global oil, like in global supply of oil, so that might suggest that inflation will continue to go up. So I don't think it will be too late. Like if you want to start going into commodities like energy stocks right now, even though governments all over the world are trying to increase interest rates and curb inflation, but we can still expect like inflation generally over the world will still trickle a bit, to continue to trickle a bit upwards before probably start seeing like a little bit of respite where it starts heading back downwards, or growing at a slower pace. Uh, so the second part of that question is saying also, how do you know when inflation has gotten to its peak so you can sell off the stocks? So so basically what you want to do is that inflation, so when inflation peaks, inflation peaks when most likely like prices are like way up, and then government has started increasing rates. So when government start increasing rates, like at that point where government start increasing their rates, inflation is about to peak. So because the next thing that comes after government increases rates is that inflation starts to go down. So at that point where that action has happened, like people are start feeling the fact that it's now more expensive to raise money to do things in the economy. At that point in time, your inflation is already like touching its peak. So at that point in time, I think most of the time there's no, like I said, there's no timing, there's no perfect timing there's no way to perfectly time the market. So at that point in time, you might get off some of these stocks, and like you might sell some of these stocks, and then the stocks might still continue to go upward, because like I said, these stocks are not just, some of these stocks are not just driven by inflation. Like there are also other fundamental factors like the performance of the company and that essentially drives like that essentially drives how a stock performs. So you might jump off and say, okay, inflation is about to start coming down. Let me jump off from this stock and take away my profit. That's perfectly fine if that's you. But also, like I said, there's no time. You can't call a time on when to sell a stock. You just have like goals that you set and say that, okay, I want to make 30% on this stock. I want to make 50% on this stock. I want to make 10%. I want to make 5% on this particular stock. So once you've achieved your goal, you did that. At that time is when you want to be backing off on any form of investment. So it doesn't necessarily have to be like when inflation have peaked that you need to sell off, because inflation peaking doesn't mean that the stocks that you're invested in will go down, because if the company is performing well, like, and doing a lot of great numbers in terms of their financials, that company will still continue to see an increase in their stock price. So I think that should answer that question. I don't know. Yeah.
Thank you so much, Tito. So listen, we've gone 10 minutes past the hour mark. I think we've enjoyed this too much. But we have to call this a wrap here. So I wanted to say thank you so much, Tito, for joining us. I want to say thank you to everyone for attending this. Um, I just posted a link to our investment club on Telegram. Um, I want us to join that group. I want us to share that group with people who are similar to us, who want to have these sort of conversations, so we can keep having these conversations. Ask your questions there. We're always there on the group. Just breezing through the vibe on there and just listening to what people are saying. So yeah, thank you guys for joining in. I will post that one more time. um that's a link to our investment club. Join on Telegram, guys. We continue to have these conversations there. Thank you, Tito, for
Thank
taking
you
your
very much.
Saturday out to join us.
It's
Yeah, thank you
perfectly
guys
fine. My
so
pleasure.
much. Yes, enjoy the rest of your Saturday, guys, and yes, ciao.
All right. Bye, guys.